In the world of wealth and value, two symbols have dominated global consciousness for centuries: the diamond and the US dollar. Both have served as standards of wealth, tools of power, and objects of desire. But when closely examined, these two are vastly different in origin, utility, and long-term reliability. This investigative article explores how the diamond and the US dollar compare in terms of value retention, manipulation, global trust, and what they truly represent in a shifting economic world. Diamonds derive their value from natural rarity, beauty, and the human emotional attachment to them. Mined from deep within the earth, their formation takes billions of years. But the price tag on diamonds isn't just geological, it's psychological. De Beers, the dominant diamond cartel of the 20th century, created a global illusion of rarity by stockpiling diamonds and controlling supply. The slogan, "A diamond is forever," wasn't just a catchphrase, it was a corporate weapon to equate diamonds with love and status. In contrast, the US dollar is a fiat currency. It has no intrinsic value but derives its worth from trust in the United States government and its economy. Since the abandonment of the gold standard in 1971, the dollar has been backed only by confidence. Yet that confidence is so strong that the dollar has become the world's reserve currency, used in 88% of all global foreign exchange transactions as of 2022. The US dollar is the most liquid asset on Earth. It can be used virtually anywhere, converted into any currency, and used for any transaction. It's the oil in the machinery of global trade. On the other hand, diamonds are liquid assets. Selling a diamond often yields significantly less than the purchase price, especially for retail buyers. Unlike gold or stocks, there's no universal exchange or spot price for diamonds due to their subjective qualities: cut, clarity, color, and carat. Furthermore, while diamonds can store wealth discreetly and are sometimes used in illicit financial movements, they are not practical for modern transactions or institutional investment. The dollar's dominance in oil markets, trade settlements, and central bank reserves gives it utility far beyond its printed form. The diamond market has been historically manipulated by monopolistic powers. De Beers once controlled over 80% of the diamond supply. Even today, companies like Alrosa and De Beers influence pricing through restricted auctions and marketing. Lab-grown diamonds have begun disrupting this ecosystem, but the traditional diamonds market remains far from transparent. The US dollar, although influenced by the Federal Reserve, operates within a relatively transparent system of monetary policy. However, it is not immune to manipulation. Interest rate hikes, quantitative easing, and political pressure have all influenced the dollar's strength. The US government has used the dollar's dominance to impose sanctions, exert geopolitical pressure, and regulate global finance, giving the dollar not just economic, but strategic power. Diamonds, over time, have not consistently appreciated in value. In fact, many consumers find that the resale value of diamonds depreciates due to retail markups and limited secondary demand. Investment-grade diamonds exist, but they are niche and require specialized knowledge. The US dollar, while subject to inflation, generally maintains purchasing power due to active monetary policy. However, in recent years, concerns about inflation and national debt have led some to question the long-term stability of the dollar. That said, during times of crisis, be it war, pandemic, or financial meltdown, investors still run to the dollar as a safe haven, not diamonds. Diamonds symbolize love, permanence, and luxury. Their value is culturally embedded, passed through generations as heirlooms, and gifted in moments of emotional significance. Yet this emotional value is not economic stability. The US dollar, however, symbolizes power, military, economic, and political. It's the currency of empires, of global trade, and of central banks. Its influence spans continents and controls the fate of nations. The dollar's symbolic strength is rooted not in sentiment, but in supremacy. In the battle of diamond versus US dollar, the dollar emerges as the more functional, liquid, and strategically powerful entity. While diamonds carry emotional and aesthetic value, they are not reliable vehicles for investment or trade. Their market is opaque and heavily influenced by branding rather than objective worth. The US dollar, despite its flaws and the growing debate about de-dollarization, remains the beating heart of global finance. As long as the United States maintains economic and military dominance, the dollar will continue to represent real, maneuverable value. Yet this comparison also reveals a deeper truth: neither diamonds nor dollars are infallible. One is built on illusion and sentiment, the other on trust and dominance. In a world where perceptions shift rapidly, understanding the true foundation of value, whether emotional, economic, or strategic, is more essential than ever. The US dollar is facing one of its most volatile decades in recent history. The COVID-19 pandemic triggered massive government spending and quantitative easing, followed by supply chain disruptions and inflation spikes not seen since the 1980s. In response, the Federal Reserve aggressively raised interest rates, strengthening the dollar temporarily, but at the cost of triggering recession fears and volatility in emerging markets. While the dollar remains dominant, it's no longer unchallenged. Major economies like China, Russia, Brazil, and India are actively exploring alternatives. In 2023, the BRICS nations began formal talks on creating a shared currency to reduce dependence on the dollar. Meanwhile, countries like Saudi Arabia and the UAE are conducting energy deals in yuan and euros, signaling a potential slow-motion shift away from the dollar's absolute dominance. Diamonds, long seen as timeless assets, are struggling to stay relevant in a digitally savvy, ethically aware consumer market. Lab-grown diamonds, virtually indistinguishable from natural ones, are flooding the market at a fraction of the price. In 2024, lab-grown stones made up more than 40% of engagement ring sales in the US, a number rising fast. Moreover, younger generations are questioning the very value of diamonds. Millennials and Gen Z consumers are more likely to prioritize ethical sourcing, resale value, and financial pragmatism. The emotional manipulation that once made diamonds essential now backfires as customers demand transparency, utility, and purpose. Even natural diamonds are feeling the pinch geopolitically. Russian diamond giant Alrosa, one of the world's biggest suppliers, faced global sanctions in the wake of the Ukraine war, disrupting supply chains and causing temporary price spikes. But these didn't translate into long-term investor confidence. The diamond's Achilles heel remains, resale value is unpredictable, and the asset class is deeply illiquid. As central bank digital currencies, CBDCs, and cryptocurrencies gain traction, both diamonds and the dollar face a new existential question. What is the future of value in a digital world? While Bitcoin is often touted as digital gold, its volatility has kept it from becoming a stable store of value. Yet CBDCs, such as China's digital yuan or the proposed digital euro, are moving forward fast, offering programmable money with surveillance capabilities. If successful, these currencies could challenge the dollar's supremacy in trade and finance. For diamonds, digital disruption takes a different form. Blockchain verification of stone origins, online diamond exchanges, and lab-grown tech are modernizing the industry, but not enough to make diamonds a reliable modern investment. Their sentimental worth may endure, but as a financial instrument, they risk obsolescence. One of the most defining features of the current global climate is the use of currency as a weapon. The US has frozen billions in Russian and Iranian assets, cut off nations from SWIFT, and used the dollar system to enforce sanctions. This has prompted many governments to seek alternatives, not because the dollar is weak, but because it is too powerful. In contrast, diamonds have long been used to avoid oversight. So-called blood diamonds financed wars across Africa. Today, stones are still moved in black markets to bypass banking systems. Yet with tighter controls and the emergence of digital surveillance, even this underworld advantage is fading. Thus, the global push toward de-dollarization and cleaner supply chains ironically puts pressure on both the dollar and the diamond from opposite ends of the morality spectrum. In 2025, the diamond and the dollar both stand at crossroads. The diamond, once an emotional anchor of love and wealth, is being deconstructed by ethics, science, and changing values. The dollar, once the unquestioned emperor of finance, is being challenged by inflation, debt ceilings, geopolitical backlash, and digital alternatives. Still, if forced to choose, global investors, central banks, and even rival nations continue to hold and trade in dollars, not diamonds. Diamonds may dazzle, but dollars still deal. Yet this may not last forever. The real question is not whether the diamond or dollar is better, but whether newer symbols of value, be it digital currency, data, or clean energy, will soon outshine them both.